An update on inflation. So that's been the story for a year and a half, ever since I think it was June of 2022. There was a 9+% inflation read. And the way inflation works is there are monthly readings, but it's an annualized number. So part of the Fed getting to its target of two, really it's kind of 2-ish%. They wanted to see a 2 in front. So even a 2.9 reading is seen as positive from the Fed. They are trying to get inflation down, but part of that is having higher readings drop off. So if you're looking at the previous 12 months readings, it's important that the higher readings drop off. What that means is that we're looking at an annualized rate, and it doesn't necessarily mean that prices, it doesn't mean at all that prices have come down. It just means that prices have stopped going up at a high rate. So there is a certain amount of inflation that is deemed as good. That's just sort of been the case for a long time. Inflation is what causes the erosion of purchasing power of the US dollar over time, but it's also what helps appreciate assets, and it encourages investment. So anyway, I'm getting out away from answering the question, but inflation has come down. It's just the Fed's policy has worked, which is to keep the Fed funds rate elevated to sort of choke off borrowing and extraneous spending, and maybe to inject a little bit of nervousness or hesitancy in consumers and businesses, to slow down spending and just slow down the economy in general. And it has worked. The bottom line is it has worked. Inflation is now below the Fed's target of 2% on a 6-month basis. So their policy has worked. Magnificent Seven has sort of replaced FANG. It used to be FANG, which was Facebook, Apple, Netflix, and Google. And maybe there was another A in there, Amazon. And now there's a Magnificent Seven, which is those same stocks. I think Netflix has for some reason come out. There's Tesla and Nvidia. Anyway, these are like the high-flying growth names, supposedly. I don't consider Apple a high-flying growth name, but these are the stocks that are leading the charge at the moment. And they led last year, and we're at the end of January, and they're leading again so far this year. They led to the downside in 2022, and I think people have quickly forgotten that. Some of those stocks were down 50, 60%. That's not great. So they're getting a lot of headline attention because they seem to go up every single day. The question is, if we own them, what do we do? I definitely think that pruning or trimming is a good idea. Obviously, you need to keep taxes in mind, but you don't want your portfolio to become overly overweight in a strategy if it's not your strategy. If you set out to have 20% exposure to large cap tech and now it's 40 because you bought at the perfect time, that may not be exactly what you're looking for, because your portfolio going forward, your performance going forward is unlikely to be what it was. And now you've got a larger weighting to something that is probably ripe for a pullback. So yes, I think trimming makes sense, keeping taxes in mind, of course. And then what do you do with the proceeds? So assuming that you decide, okay, we're in a tax deferred account or I'm prepared to pay the tax bill, there's a lot of things that look good. There are parts of the market that haven't kept pace. Not that they're doing poorly necessarily, but they haven't performed as well as some of these Magnificent Seven. Healthcare, small cap stocks, and then of course there's always fixed income, which we were talking about it a lot last year because it looked really good when the 10-year was above 5%. Of course, it's come back down. It's closer to 4%. But it's still, I think, a decent opportunity relative to what we've seen in the last 15 years. So I think you can pick and choose a little bit within fixed income. If you are in a taxable account, longer-term municipal bonds, I think, look terrific because you're getting 4.25% entirely tax-free. So your tax equivalent, depending on your tax rate, could be 7.5% with very, very limited risk. It's a terrific question, and it's fascinating to watch the shift in sentiment. Just in the last in the last 12 months, there's been multiple shifts, but in the last 3 months has been so notable. Because in that time, as you mentioned, the 10-year was at or close to 5% just 3 months ago. And the market was 15-20% cheaper than it is now, depending on what index you're looking at. And nobody wanted stocks in October of last year. Everybody wanted CDs, treasuries, and the safety of a fixed return. And now here we are 3 months later, the market has run to all-time highs, rates have come down, so you're no longer, those options aren't on the table, those same juicy 5% yields aren't on the table. They're still good. But now we're getting different questions. We're getting questions about, like, why don't I own all 7 of the Magnificent Seven? Why should we be sending you more money to buy stocks? Are we too conservative? And it makes sense that people would ask these questions because we just the headlines they're in your face all the time, and if they're not scaring you, they're getting you excited. And but it really is a good indication of where we're at in the short-term cycle, in my opinion. So I think the people who were afraid of stocks and are now excited about them, that sends me a message that I think this is not the right time to be excited, which does not necessarily mean there's an impending crash coming, but I think we've seen a lot of upside in the last very short period of time. I think we need to temper our enthusiasm and not necessarily batten down the hatches, but let's reset expectations. If you missed a big run in the stock market, sometimes the best thing to do is to just accept that you missed it and not try to get back at the market, make up for this opportunity cost that you missed. It's in the past, and we need to play the hand that we're dealt. And right now, the market is at an all-time high, which is not necessarily bearish, but it's not the time to be taking more risk. It might be a good time to be sitting down with your advisor, whether that's us or somebody else, and saying, hey, let's reevaluate what our perspective is and what we're looking to get from our investments. And is this an achievable goal at this point? Do we need to maybe be patient for a period of time before we deploy new capital? I think it's just really interesting because we've swung from extreme fear to extreme greed in terms of stock market enthusiasm, and that's on its own is not dangerous, but definitely one eyebrow is up over here. It's actually not a super popular topic, probably because it's not fun to talk about, and it's kind of a third rail. It's just so easy to offend or say something that somebody's not going to like when it comes to this topic, politics, and how it affects your investment philosophy or your sentiment towards investing, and even the U.S. economy. So we'll show a chart which is sort of interesting to me. With there has never been a larger discrepancy between how Democrats and Republicans feel about the economy. Meaning, at this moment, we've got Democratic leadership, and the Republicans voters feel very, very pessimistic about the economy. Democrats feel fairly optimistic about the economy. And the spread is so wide, it's almost like they are watching well, they certainly are. They're watching different news programs. They're reading different things. In some cases, I think they're adhering to different facts when it comes to what's actually happening in the world. And it's not our job to be political or to tell people what they should believe, but the stock market relies on earnings of the companies that make up the stock market in order to trade based on a certain multiple. That's it. Politics really, historically, don't influence the stock market very much. So if you're a Republican and you're feeling pessimistic about the economy, then you have to explain what am I missing? Because the economy seems okay. There's no data point you can pull up that says that the economy is bad, other than maybe your neighbor is out of a job for whatever reason. And if you're a Democrat, you can say that, oh, things are terrific. Are things terrific? I think that the market is a leading indicator, and the market is happy that that inflation is under control and that we can anticipate rate cuts from the Fed, hopefully later this year. And certainly the market is doing okay. The market is doing terrific if you look back 12 months. It's doing okay if you look back 24. So there's a little something for everyone when it comes to dissecting the data. But it's interesting that that there can be such a discrepancy between people from different political affiliations. And obviously we all know that there's tension when it comes to the political subject, and it's never really felt like this to me in our lifetime in terms of, just heat. It's a hot topic. The what could go right, this video is harder to answer than in some previous videos. And we've had situations like this where we do a video after a big run and things feel good. And to answer the what could go right in those situations is different, because things have been going right. The Fed has seemingly engineered this soft landing where inflation comes down without a spike in unemployment. Unemployment did start to spike late last year, and it's already started to turn back down, which is really interesting. Home affordability was a big question mark through last year, and that seems to kind of be working itself out. Obviously, rates are a big part of that. Mortgage rates following the 10-year Treasury, and house prices never really cratered. Maybe they've come down a little bit in certain areas, but with rates coming down, that becomes a little bit self-fulfilling. It helps itself over time, and rents have also come down, which people need a place to live, whether they rent or buy. So unemployment, if unemployment stays roughly on the trajectory that it is, which is not moving a whole lot, staying kind of at historical lows, if the political cycle doesn't ramp up too much, that's a lot to ask. But I guess the positive angle, even if if the incumbent were to lose, which means Trump most likely is the most likely candidate on the Republican side, at least it's a known quantity. We've had him as president before. We sort of know what to expect. So one way or the other, it's a president that we've already had. So I guess that's one way to look at it. And after a big market year like last year, history says that we don't tend to have a down year. I don't think we're likely to see the returns that we saw in 23, but having a single-digit positive year or a low double-digit positive year is within the realm of possibility. So what could go right is sort of boring. It's a little bit of like more of the same, and maybe these geopolitical conflicts perhaps they don't resolve themselves this year, but maybe they don't get worse. That's, for lack of a better way to look at it, maybe they tire themselves out and just sort of become less bad. I think that's one thing. So Fed having engineered a soft landing, and we do end up getting some rate cuts. Maybe they don't come as quickly as people think, but towards the end of the first half of this year, we get some cuts, and the economy just sort of remains stable. I think that's best case scenario.